FlatexDEGIRO is the fastest growing European online broker, operating in 18 countries. Compared to other brokers, FlatexDEGIRO is making much larger chunk of their revenues from commissions rather than interest income. Their clients are using only 1 billion euros worth of margin loans, which means the average customer leverage is just 2.5%. So, on the one hand, there is more growth potential on the margin side, but on the other hand, the currently low margin levels indicates that the client base is more conservative and it is not just full of gamblers speculating in the recent bull market. Internal costs per trade are down from 1.44 euros in 2019 to currently only 50 cents per trade. Still, even after the cost reduction efforts, FlatexDEGIRO is the least profitable of the brokers compared in this video. However, it is partly explained by them spending about 10% of revenues into marketing, which is by far more than what their competition is spending. It makes sense as they are operating in multiple high-growth markets and they are getting great returns for their advertisement. Average customer acquisition cost is 60 euros and the payback period is less than 5 months. While Avanza and Nordnet operates in already mature Nordic markets, FlatexDEGIRO is also operating in 285 million people growth markets, where only 8% of the targeted population currently do have online broker. So, if they execute well, they should grow over time at faster pace than the Nordic competition. Currently, they are outgrowing all the European main competitors in customer acquisition combined. The longer the customer stays on the platform, the higher the revenues become. And churn rates are solid, with 69% of their 2014 customers still staying on the platform today. Their customer base is the youngest from the brokers I'm comparing, which means that the average assets per customer are low, but if they can keep the current customer base in the platform, they will grow at fastest pace. As the customers' assets grow over time, so do revenues. Revenue growth is not quite linear with the asset growth, but with a clear correlation there. Highest revenue growth in customers is between ages from 18 to 44. However, even though these customers are young and less wealthy, I think the client's quality should be decent. Most of the COVID stock market boom gamblers with no prior experience of investing, who just wanted to speculate in meme stocks, cryptocurrencies, and to take high leverage bets, went into platforms like Trade Republic, eToro, and Trading 212 in Europe. Those are the Europe's equivalent platforms of Robinhood in the US. In the earnings call, the CEO joked about that while FlatexDEGIRO advertises on places like Reuters and Bloomberg, these other platforms advertise on places like TikTok. The trading activity has normalized in Q3 from pandemic levels. When comparing FlatexDEGIRO's customers' trading activity to Avanza's and Nordnet's customers, it is pretty much in line with them. Avanza and Nordnet are the highest quality online brokers in Europe, so it is another indicator that FlatexDEGIRO's customer base should be decent. Adjusted EBITDA is down but still on solid levels. When looking at the 2021 income statement, their long-term variable compensation cost was almost 60 million, which is more than their entire net income for the year. At first glance, it looked very bad. However, it wasn't a cash cost, but the provision set aside for a long-term compensation plan. They issued stock appreciation rights to the management in 2020, and the compensation amount will be 50% dependent on stock price and 50% on the earnings per share. As both stock price and earnings skyrocketed in 2021, they increased the provisions for the plan. However, as the stock price fell in 2022, the provisions were already adjusted down by 20 million. The provisions are just accountants' educated guesses of what the compensation might be, but the management will only get paid by 2026. So, if the stock price and earnings are high in 2026, then the compensation is high, but it is also good for us. If they don't do well, the management won't get paid much either. Based on 2.5 billion liquidity portfolio and assumption that European brokers won't keep passing interest to customers, there is 62.5 million additional earnings before taxes potential at current 2.5% ECB depository rates, and the rates may keep rising later this year, leading to even more possible profits. Currently, in Europe, all the brokers and banks want to keep majority of the interest benefit for themselves, and there hasn't been any competition so far for customer deposits. However, at some point, when the competition increases, they will be forced to pass majority of the interest rates to their customers, or otherwise customers will keep their deposits elsewhere. Still, in the short term, rising interest rates will offer nice earnings boost, but it is absolutely not going to be sustainable. The 2026 vision is to have 7 to 8 million customers, up from current 2.4 million. It is very unlikely to happen, as customer acquisition has already slowed down significantly, but by 2030 they could achieve that target. They also want to increase adjusted EBITDA margins above 60% by then. When you compare it to prior year's earnings, excluding the temporary high marketing expenses, it's not that crazy target, and as they achieve more operating leverage, they could hit the 60% adjusted EBITDA margin target. However, the competition may also be tougher in the future, with companies like Interactive Brokers focusing more on capturing retail market share. So, in my valuation model, I'm not going to assume them hitting these targets. If they achieve their target to have 250 to 350 million transactions and 1.5 billion in revenues in a year with low market volatility, then let's assume improved 40% net income margins, and it will lead to 600 million in net income compared to the current market cap of 800 million euros. There is the 20x upside potential for this stock. I don't think these plans are realistic, but then the stock is already priced so low that they don't need to even get close to these targets in order for you to get good returns on this investment. So for the valuation model, I'll assume 0.8% revenue take rate from customers' assets. Currently, customers' assets are 42 billion euros, and again, I'm expecting no equities appreciation over the next decade. And I'll assume the equities to be on average 10% below the current valuations over the next decade, leading to customers' asset balance of around 38 billion euros. With the 0.8% revenue take rate, it will lead to 300 million annual revenues. I'll assume the net income margins to be 20%. Long-term net income margins could easily go to 40% as they achieve higher operating leverage, but I wouldn't dare to assume that on my valuation model. So I stick with 20% net income margins, leading to net income of 60 million euros. Customer growth rate between 2015 to 2022 was 45% annually. However, the DEGIRO acquisition really boosted those numbers. Prior to acquisition, Flatex grew at 20% annual rate. Currently, management says that even during down markets, they should increase 400 to 500,000 customers annually, which would be close to 20% growth rate. However, the growth rate seems to be already below that level in Q3 2022. I'm going to be a bit more conservative than the management, and I'll assume customer acquisition to average 12% annually over the next decade, and then slow down. As the average customer savings are already quite low, only around 70,000 euros, the new customer additions, even though they will likely be on average less wealthy than existing customers, shouldn't bring the average customer size down that much. So I'll assume that the 12% customer growth rate will lead to 6% annual revenue growth rate. No customers' assets appreciation over the next decade, and after that 5% annual appreciation. Net inflows from existing customers will likely be higher than competition in percentage-wise, as FlatexDEGIRO has the lowest average assets per customers and youngest customer base. I'll assume net inflows to be 6% annually, meaning that on average customers will deposit 88 euros monthly into their accounts, which in absolute terms is still much lower than their competition. Then each decade the net inflows will decrease by 1%. Then, as FlatexDEGIRO's customers' assets grow over time, I believe the revenue take rate, which is currently higher compared to Avanza and Nordnet, will decrease at slightly faster rate of 3% annually. Regarding to capital allocation, currently they do have something around 50 million euros of excess capital. There was recently a regulatory audit on them, and they were reporting their risk-weighted margin loans default risks the wrong way, So they will need to keep the excess cash in the business until the reporting is fixed. After that, they should have around 50 million excess capital, but it is likely going to be used on the balance sheet to support the future growth. So I'm just going to discount that cash with 100% discount rate. Till today, they haven't paid out any dividends to shareholders. However, the management is planning to start distributing profits to shareholders in a couple of years if the environment is right for it. So I'll assume that they will need to keep some profits to support their growth plans, and dividend payout ratio could be around 50% over the first decade and then go up after that. So combined growth rate for the first decade is 8%. After that, when I take into account the 5% annual equities appreciation, the growth rate climbs to 11% over the next 5 years, and then the growth rate keeps declining by 1% every 5 years. Dividend payout is 50% in the first decade, going to 70% after, and then up to 90%. It will lead to net present value of 1.6 billion euros, which is double of the current market cap. Or if you increase the discount rate, then the stock will be currently fairly valued for 13.5% annual return. On top of that, I was, in my opinion, a bit conservative on my growth rate assumptions compared to the other brokers I valued. And net income margin is only 20%, but it could easily go to 40% over time, already doubling the valuation. If the management executes their 2026 vision, which I don't think they can do, but if they did, the stock would likely go up 20 times from the current levels. So there is definitely upside potential. If instead I lower the growth rates by 3% annually, the stock will be still fairly priced for 10% annual return. So there is some room to be wrong on the growth assumptions and still make decent returns. Hello there! If you want to see my full industry analysis of online brokers, well, I value 5 different companies and then I'll disclose the investment or trade that I made. Check out this video here.